In this video, we'll talk about some taxes and payroll taxes, as well as other payroll liabilities that we have to worry about. Sales tax payable. The key here is if your target and you sell merchandise for $100 and there's 7% sales tax, as a customer, do you give Target $100? The answer is no, you give them $107. And the reason is they are collecting the sales tax for the government. Target doesn't get to keep that 7%. They have to transfer it either to the state or the local government. The key here is there is no such thing, and this makes a great multiple choice question, as sales tax expense. So the entry when you make that sale, how much revenue does Target really have? They have $100 worth of revenue. They're going to collect cash of $107. And so this extra $7, first of all, it has to be a credit, so you know it can't be an expense. That's going to be sales tax payable because we owe that to the government. And they get really mad if you try to keep that. You can go to jail, and people have. That takes us to payroll. You know that when you get paid, the amount that you work is not the amount you get in your check. My granddaughter, at one point when she got her first job, she was trying to save for something, and she counted her hours, and she knew her rate per hour, and she was all ready to go out and go shopping when the check came. And she was very disappointed when the check wasn't the amount she expected. The wage expense for the company is that gross amount. It's the amount the employee earned. So again, that's the gross amount that you always wish you could get. The wages payable, though, is the amount of cash due to those employees. And there's a whole lot of things that make up that difference. As an employee, you know you have income tax withholdings. This is really very employee specific into the amount. Sort of like the sales tax payable, where the company is just collecting it for the government because they know if they made you wait till April 15th, nobody'd have the cash to actually make the payment. Then we have that FICA, and FICA is Social Security and Medicare put together. Social Security is our retirement, which sometimes they call this OASDI, Old Age Survivors and Disability Insurance. Medicare, they take that out of your paycheck, so then when you get 65, it will cover your medical. Both Social Security and Medicare are separate programs, but they're administered by the Social Security Administration. So a lot of times people lump them together, call them Social Security, even though Medicare really is a separate program. And then there's all those other things that they might take out for your check. You might have to pay something for your health care, union dues. And there's all sorts of things you can elect to do. You can do some charitable donations through your paycheck if you want. Set up a health savings account. It basically is a way to avoid taxes on those earnings. So then there's a whole lot of these elections you can make to also reduce your check. I'm going to put in here your pension. You guys are all young enough. You really should try to put in your pension and maybe even a little bit extra if you can do a 401k. So these are the ones you know about because it comes out of your check. But what you don't realize is the employer has to pay a lot of these too. And the big one for them is they have to match that FICA. Whatever you pay in Social Security and Medicare, they pay it too. So the government really gets double the amount because you pay this and the employer pays. You're going to pay like 6%. They pay 6%. So in essence, the government gets 12% of every dollar earned in the U.S. up to a certain limit. The thing that only the employer does is they pay something called unemployment taxes. And those are what funds the unemployment benefits that you hear so much about right now. So as the employer, things up here will be a payable to the employer. And again, not an expense because they're just collecting it for the government. These things down here that they just pay, these are an expense and a payable. Here they're collecting to be nice. Here, that's actually a cost to the company. I'm going to keep it simple. We got 3 employees, Social Security rate, and this is the true rate, 6.2% for both the employer and the employee. But there's a cap, and this year it's 142,800. In book problems, be real careful because this changes every year. Amazingly, it goes up. And so the problems in the book will more often than not have just a different number. The book was written probably 2-3 years ago. The Medicare rate, and this is true as well, is 1.45% for employer and employee. No cap on that. So again, think about it. That means the government gets basically 3% of every dollar earned in the United States. And then we don't really care about this, but if you ever are doing payroll, that's important. There's the federal and state income taxes. Those are withheld. When you start a job, you always fill out that little W-4 that says, are you single? Do you have any dependents? Do you want to have them withhold a little extra money? And so that's very specific to every individual. In problems, that's got to be given because there's no way to really know how to compute that. Employers only, again, have to pay that state and federal unemployment tax. Federal unemployment is really 6% of your gross compensation, but they give you a discount if you pay your state unemployment. So your federal gives you a discount if you pay your state on time because they want you to pay it. And so it ends up really being 0.6%. The Illinois, the state one is a little bit more complicated because it depends on the kind of company you are. Construction companies, for example, will pay more in unemployment than a university because they have more unemployment claims and those kinds of things. So we'll assume it's 1%, and I'll leave it 1% all the time. The unemployment tax, the two together, will be 1.6%. We're going to do April's payroll. We've got 3 employees, Miller, Madison, and Matsumura, and those are the authors of your textbook. We need to know how much we've earned before April because we've got like that 142 cutoff for our Social Security. Income tax withheld, I told you, always has to be given. So that's just what people request to be withheld. So I've got a little place here called the earnings for I'm going to call it FICA because it's easier to say. And so that would be how much you earned this period, keeping in mind that you only pay up to 142.8. Again, think of what that means. That means if somebody's making $150,000, they pay the same amount in Social Security as Warren Buffett, who makes billions of dollars. You'll hear that's a regressive tax, and maybe we shouldn't have a earnings cap, but it's really hard to change Social Security. This person, Miller, doesn't owe anything more in their Social Security. Madison was at 95. They just did 15, so I think that's 110. This period, they've got 15,000 that they have to pay on. And poor little Matsumura, she has to pay on that 1,200. I want to take these numbers times the 6.2%. That's the amount that will be owed for both the employer and the employee. Nice thing is Medicare is nice and easy because whatever you earn, you pay on. If you hit that F4, you get the little dollar signs around here. And that's function 4. Copy down. It will keep going back to this number. Unemployment, 13,000 is the cap. So you pay only on the first $13,000 you made. Or it was paid on Miller a long time ago. It was paid on Madison a long time ago. For Matsumura, there's still another $19.20 I have to pay because they have not reached the 13,000. The journal entry we're going to make. First, we have to pay people. Okay. And so since these look like they're on salaries, I'm going to call it salaries expense. If they're hourly workers, we call it wage expense. If they're salaried, we call it salary expense. Doesn't make any difference. The expense to the company is based on how much you worked. So that 36,200 is the salaries expense. And surprisingly, that's the number students mess up on the most. Then the rest of these things are payable. Income, tax, withheld, payable. OASDI, payable. We've got Medicare, payable. But remember, the unemployment is the employer only. That does not come out of your check. Thank goodness there's something that doesn't come out of your check. So the amount of cash the company is really going to pay, again, you can make it salaries payable or cash, depending on what they tell you. That's paying you. The second journal entry is for the payroll tax expense. And these are the extra expenses to the company. This income tax payout withheld, that's just yours. That's the employees. But the employer does have to match that FICA. They do have to match that Medicare. And then they have that unemployment tax payable. So their expenses to keep you working is this one. If I sum it, I know the total amount. This is also posted on Blackboard. Here, life was easy. Nothing was close to these cutoffs here. What I'm changing here is, let's say Miller Nobles, she earned 130 last 3 months. So this month, if I had 130 and 20, now I'm at 150. So she's bumping over this border this month. And the amount is this 12,800. If I take 130 plus 12,800, that puts her at that border. That's all she pays in Social Security, and she won't pay for the rest of the year. She's done. The other thing I changed was Matsumura. I changed that to 12,300. So now, if I do 12,300 and 1,200, she's going to be up over that 13. So the unemployment is what changes, and the amount she's off is that $700. We'd take that times the 6.2. On this one, we would only take the 700 times the 1.6. All the other numbers would stay the same except for those. Most often in problems, we'll give you at least 1 or 2 people that will be right at the cap. So you'll have to do this little calculation. There's a couple other things dealing with payroll, but going back to the matching rule, remember we want to expense things in the period that they happen. We use the word incurred. Because of that, when the revenue is recognized, I want to try to expense everything that really belongs in this period, this period. Some of these are really complicated dealing with payroll. For example, one of the big ones is pensions. You're going to recognize pension expense when the people work, not when they retire. Because the only reason you have to pay them when they retire is because they work today. We also have to do this with vacations. The only reason you get a vacation day is because you worked another day. This has to be paid vacation. We want to expense your paid day off when you worked. You earn the day off because you worked some other days. Let's say employees make $100 a day, and this period they earned 30 vacation days. So we're on December, and let's say it's the first year of operations. We'll make life a little easier. So they haven't taken these days. We just promised to let them off next year. I need to expense those this year. 30 times 100 is 3,000. I want to recognize the expense this year and vacation payable. It's a liability because I owe you, but I'm owing you days off. We want to expense in year worked, not in the year of your vacation. Normally, this is just one of those adjusting journal entries. And anytime you promise to do something for an employee, it may have some financial statement effects. Bonuses, you want to recognize the bonus in the year it's earned, not necessarily in the year it's paid. And this is just a nice little algebra problem. Let's say that your net income before the bonus is $500,000. We know that the net income before the bonus is $500,000. We want to subtract out the bonus to get our net income. This is before the bonus, but we want it to be 10% after the bonus. So the bonus, my B here, equals 0.1 times my net income. I can substitute this 0.1 net income for my B. So I know 500,000 minus 0.1 net income equals my net income. Remember, there's really kind of a little 1 here, so 1.1 net income, because I'd have to add that to both sides. 500,000 divided by 1.1, and that equals, it's one of those repeating numbers, 454545. So that's your net income. I want to know what the bonus is. 500,000 minus something equals 454545. The something is the bonus, and that is 45455. And if you subtract that, that comes lots of 4s and 5s, but it all works. So that's how you figure out what your bonus is. You probably won't pay them until January because you don't know really what your net income is in December. You'll go ahead and book bonus expense and bonus payable. So that's the end of this one. We'll do contingent liabilities and warranties in the next one.